ladies and gentlemen. Welcome to the CFA Society of Boston. I'm Michael Underhill, the Chief Investment Officer of Capital Innovations. We're going to have a discussion this afternoon, a little bit of a survey of the waterfront of infrastructure investing entitled Lies, Damn Lies, and Statistics. I'll pull up the slide deck here. You can ask questions interactively, as well as we'll have a Q&A for about 10 to 15 minutes at the end. There we go. And I think what you'll find is when we're examining infrastructure as an asset class, the most important thing to remember is the only constant is change. There we go. So we start out here a small sampling of what we've done over the last, call it 16 years of infrastructure investing. This slide deck is intended for commercial purposes. The risk factors, all the legal disclosures, everything here, everyone should be well aware of them. If not, take a brief view here. We'll go over some of the things that inherently make up infrastructure as an asset class. So when we talk about infrastructure, it's a large and growing global opportunity. Trillions of dollars that have been invested in airports, seaports, toll roads, with the intention of increasing the economic standards and development on a global level, OECD, non-OECD, developed markets and emerging markets. The public and private market investments will define and delineate all of the different public and private market vehicles. But when you look at it, the trillions of dollars that have invested in infrastructure over the last 30 to 40 years really have been so through public pension funds, sovereign wealth funds, different types of private equity, private debt funds, with a focus on generating attractive historical returns, both through equity and debt, primaries, secondaries, co-investments. But you look at the underlying asset class itself, it has a very low degree of correlation to traditional securities. You're seeing an increasing demand in infrastructure, so much so that when you look at whether it's the energy transition, migrating from traditional hydrocarbons to renewables, digital infrastructure, even enhancement of aging infrastructure, these investment trends or mega trends, as we talk about, they really align well with the sustainable development goals. And when you look at all of the different types of SDGs or sustainable development goals, infrastructure as one of the largest and the largest, fastest growing sustainable investment strategies is expected to account for roughly about $50 trillion of assets under management globally by 2025. Now, when we talk about infrastructure as an asset class, it's a series of subsectors, if you will. In energy, we're talking about storage and transport, gathering and processing. When we look at transportation, specifically toll roads, airports, marine ports, railroads, we see an acceleration of capital investment, the need and a desire to invest in infrastructure. I just got a note here. And let me see, is that better? There we go. So hopefully that's a better format for presentation mode. So when you look at what's going on, essentially there's a desire, a drive for investment across energy and energy transition, and things like utilities make it exceptionally helpful, beneficial, as we're seeing not only electric and gas utilities, but wind and solar renewables, as well as nuclear. That's becoming a large and growing component within energy and energy transition, particularly in the utility space. And not to mention water and wastewater utilities, we're seeing a lot of retrofitting, refurbishing, and maintenance, CapEx, in water utilities. So that's a large and growing segment of the investment marketplace, investable opportunity set. Communications infrastructure, when we look at what happened with the shift from 4 to 5G, and now the acceleration of artificial intelligence, you're seeing billions of dollars of capital flow into satellites and cell towers, but then also across that digital bridge from cell towers to things like network infrastructure. So I think data centers, smart grid infrastructure, fiber to the home, and other types of digital infrastructure that roughly needs to accommodate about 25.4 trillion devices. Think phones, think stoves, refrigerators, multiple appliances and devices that will be connected to the Internet of Things. So digital infrastructure, huge segment with communications and network infrastructure that's driving the global opportunity set. And not last but not least, storage facilities. When you look at storage facilities, one of the largest and growing industrial sectors across warehouses, distribution centers, and logistics facilities. I think when you look at all of those things within infrastructure, you've got different returns, different risks, and can build a diversified portfolio, whether you're approaching from a private markets perspective, primary, secondaries, co-investments, or even from a public markets perspective. So when we look at what's going on with infrastructure, and we had talked a little bit about economic sensitivity and resilience, but also interest rate sensitivity. I think what you're finding is there's a desire to build a diversified portfolio, but I think there's also a desire to be cognizant or conscious of the interest rate environment, which is higher for longer, as well as the economic environment, whether you're reading news from this week, this month, this quarter. What you're starting to see is a slow deceleration. You're seeing inflation that's pervasive, sticky. Rates are higher for longer. So building your infrastructure investment portfolio, being cognizant of where you are in the rate cycle, having less sensitive assets as opposed to more sensitive assets, and being able to have a bit of a diversification element that incorporates economic sensitivity, said a different way, folding in water and towers and pipelines as well as satellites, so that it's a little less economically sensitive. Admittedly, because we're heading into what should be a deceleration in our economy over the next 12 to 24 plus months. Now, when we talk about those big mega trends, taking a step back and looking at just some of the structural investment and structural underinvestment that's leading to a favorable backdrop with infrastructure, you've seen decades-long underinvestment in infrastructure globally, emerging and developed markets. You're starting to see finally with commitments from countries to finance infrastructure projects, whether you're talking the roughly $1.2 trillion Infrastructure Investments and Jobs Act, the $386 billion Infrastructure Inflation Reduction Act, which was really infrastructure and onshoring. When you talk about renewables and utilities and battery production, and even the CHIPS Act, when you look at some of the money that's been put into manufacturing chips and actual digital infrastructure technology, there's significant fiscal stimulus that's been enacted in the last 3 years in the US, as well as in Europe. You're seeing fiscal stimulus that now they're having their own version of the fiscal stimulus called Inflation Reduction Act. They've changed the title a little bit, but admittedly they're trying to spur manufacturing, spur production, nudge forward GDP with fiscal stimulus to complement all of the monetary policy over the last 10 to 12 years. One of the other big structural trends that we're seeing in terms of upgrading of digital infrastructure, as I mentioned, 4 to 5G, that huge tectonic shift, but also global data usage, and the increase of global data usage increasing 30% per year. The build out of towers, fiber networks, data centers, fiber to the home, and even smart grid infrastructure continues to require financing, both equity and debt. So that upgrade presents a significant opportunity set for institutional investors. And last but not least, when you talk about energy resilience in the environment, the resilience is not only the shift from hydrocarbons to renewables, but also more consistent forms of power, things like hydrogen as well as nuclear. And the transition from lower carbon to more sustainable solutions, it can be seen in just some of the shift. If you were to look at from 2005 to 2022, the shift from coal to nat gas reduced carbon emissions in the United States by 23%. New technology required new infrastructure. The move from gas to things like nuclear and hydrogen and renewables will require more investment, trillions of dollars of additional investment. So I think when you look at something like that, it presents a unique and growing opportunity set. The case as a fiduciary for investing in infrastructure is actually quite simple: stable and predictable income, attractive historical returns, and lower economic sensitivity, along with inflation protection potential. So you're thinking stable and predictable income. How is that? The underlying assets, large monopolistic characteristics of infrastructure, long dated contracts, think airports, seaports, toll roads, regulated utilities that have large take or pay contracts and large offtake agreements to hedge out commodity exposure. historically, that's generated consistent returns as little as 10 to as much as 15%, depending upon whether you're looking at core or even opportunistic. And I'll share some data with you around just expected returns. And we talked a little bit about economic sensitivity pursuant to what type of sector you're looking at. There's various degrees of economic sensitivity, as well as when you look at it, having an investment in a toll road, investment in a utility like a water or wastewater utility, very low degree of correlation to something like common stocks, S&P 500, or even investment grade bonds. The inflation protection we talk about is something that's not only tied into monopolistic business models, defensible market share, but they have high barriers to entry. So think utilities. The inflation-linked pricing in their contracts is a pricing power component. So think about whether you're in Boston or New Jersey or New York, utilities continue to increase prices to consumers as well as to commercial customers. So they have pricing power, and that pricing power continues to generate cash flow. And those inflation-linked pricing elements of their contract help the companies in terms of price profitability, but also act as a potential hedge against future inflation. And we'll talk about listed and unlisted or listed and private markets. If you were to just take a quick snapshot on listed infrastructure, market capitalization roughly 2.5 trillion, annual growth about 10.5, called 10.4, compounded annual growth rate since 99. And if you look at the yield, roughly about 100 basis point premium over global equities. So listed infrastructure providing a stable and growing yield, as well as a lower degree of volatility when compared to global equities. So listed infrastructure has been a component in US and international pension fund portfolios for almost 30 years. And what you're seeing is a large and growing cast of institutional, as well as family offices, as well as advisors trying to gain access to listed infrastructure because of the inflation protection, the income, and the overall capital appreciation and significant yield in an environment that admittedly some of the equity investments haven't been providing the yield needed to hedge against inflation. If you look at just private infrastructure and the consistency of returns, you've seen both capital appreciation and income. You've seen for lack of a better phrase, a consistency over 20 plus years. And just since 2009, if you were to take a look at a rolling 4-quarter global infrastructure snapshot, you're getting roughly 5.5 to 6% in capital appreciation, 5.5 to 6% in income. And so generating anywhere from 11 to 12% returns over full market cycles. So the consistency of infrastructure has been an appeal for institutional investors, think pension funds, endowments, and foundations. And as family offices and financial advisors are experiencing or having a bit more of a visit of their asset allocation models, they're incorporating more infrastructure, both public and private markets, in their asset allocation models or their outcome-based investment models. We talked about consistency. I'm just going to move this over here so we can see a little bit better data in the chart. When you look at this, infrastructure from 2012 to 2021, infrastructure returns were roughly about 12.8%, where the annualized volatility was only 3.9. Said a different way, sure, you could invest in venture capital in the same time period, generate a 22.7 rate of return, but you have to take 3 times the risk to get that twice the return of infrastructure. Infrastructure gives you the efficiency in terms of return, but a significant reduction in volatility, which is a nice return enhancer to complement private equity, complement venture capital, and complement even real estate as an investment. So the characteristics of infrastructure, if you take a look at it, it's really providing an essential service. Think the backbone of the growing economy, US and globally. Irreplaceable public services with inelastic demand. So think utilities. The monopolistic or high barriers to entry, large capital outlays, defensible market share, regional advantages, contractual and regulatory frameworks, for example, roads, and stable and long-term cash flows. We think about things like rails as well as airports and seaports, but railways have long life assets or contracts that are often more than 30 years in duration. And when we talk about some of the elements of inflation correlated revenues, the owners of infrastructure are often able to pass through inflationary costs onto the consumers, which gives that end investor some significant inflation protection. So when we look at, I had mentioned outcome-based models, even asset allocation models, even if you just take a look at a 60-40 model and take a look at equities versus bonds, you see that light blue colored bar there. Portfolio one is just 60% equities, 40% bonds. Portfolio two is 50% equities, 30% bonds, and 20% infrastructure. Said another way, adding an infrastructure gives you inherently better returns, more efficiency to your portfolio, better standard deviation, lower standard deviation, but better risk-adjusted returns over full market cycles. And we have a couple of these charts in Efficient Frontier and a couple other data points available for follow-up, as well as there was a paper we just published, a white paper on the impact of adding infrastructure into investor portfolios. So we talked a little bit about the mega trends. If you were to take a look at some of the things that are driving the investment opportunity set, we touched upon digital transformation in terms of explosive data growth. We touched upon energy transition, both from hydrocarbons to lower emissions, as well as zero emission energy and power generation. But also there's a third big megatrend, enhancement of aging infrastructure. So I think capitalizing on the repair and enhancement of existing infrastructure assets, which is critically important. The American Society of Civil Engineers has a report out there that if you were to look at it, the U.S. is roughly a C minus student in terms of the infrastructure and its viability in the United States. And I think if you look across these three big themes, digital infrastructure is one of the biggest in terms of just the need for transformation. The move from 4 to 5G has been helpful, but I think artificial intelligence and the data consumption over the coming years is nothing short of stunning. I dropped this statistic earlier, but basically 25.4 billion devices will be connected to the Internet of Things by 2030. So think refrigerators, stoves, not only phones, but computers, all types of smart devices. And you look at the data growth from 2019 just to 2025, it's roughly a 400% increase in data consumption. And that kind of data growth and data consumption leads to the investment thesis around digital infrastructure and digital transformation, of which you see roughly about a $3.7 trillion digital transformation opportunity set. It's said another way, if you look at some of the research out there, this is referred to as the fourth industrial revolution. And it's going to create roughly 3.7 trillion in value from 2018 to 2025, which literally 2025 is right around the corner. So I think the technologies with robotics, artificial intelligence, and additive manufacturing are already starting to generate productivity increases. But I think as digital technologies expand, you're going to see the investment in digital infrastructure is going to be required to keep pace with growth. Energy transition, we touched upon it, but if you were to look at what's gone on with climate change and the goal to limit warming, reduce emissions, you're seeing roughly 80% of fossil fuels generating energy consumption, but basically emissions. And so fossil fuel reduction and the ability to invest in things like nuclear and renewables and hydro, those are the biggest trends that are A, profitable, B, lower emission to zero emission, clean. And you see the largest energy generators with those three big technologies, renewables, nuclear, and hydro, between 2030 and 2040. And so the levelized cost of energy and technology in the advance in technology, and again, this chart here comes from BP, right? One of the largest integrateds out there in terms of oil and gas. The biggest investors in renewables and nuclear and hydro are big oil. So we're seeing these big companies, and they know that the future is better technology, lowering emissions and moving towards zero emissions, and investing billions and billions of dollars into renewables, nuclear, and hydro. So the investment opportunity set with an energy transition is large, but it's growing on a daily basis. And if we talk about just the cost of wind and solar, as well as natural gas and coal, and the levelized cost of energy dollar per megawatt hour, you'll see that nuclear is very competitive. Coal has actually gotten more expensive. And admittedly, you'll see things like nat gas that is trading, and now it's starting to creep up again in terms of pricing. So I've been a big bull of nuclear energy, both public and private markets. There's a way to get at nuclear energy. I'm happy to entertain questions around nuclear because I think it's a fascinating, small scale nuclear, fascinating technological advance, permitting not only an investment thesis that's making significant returns, but making a significant impact not only in zero emissions, but also recycling of spent fuel rods, where you're starting to see nuclear, small scale nuclear technology. They can recycle the spent fuel rods and reuse them, so there's zero emissions, but also zero nuclear waste. We can talk more about that after the presentation here at the Q&A. And again, when you look at clean energy equity performance, you've seen it high volatility profile over full market cycles. But I think what you're seeing is a little bit more consistency. You've seen a pullback in refinancing with the surge in yields over the last 30 to 60 days. It's equities in the clean energy space has taken a hit, particularly if you were to look at renewables. So I think with that retrenchment, with that pullback, there's an opportunity to enter in a favorable cost basis. So I think right now, clean energy equities are looking pretty attractive and pretty cheap. But when you look at their performance over 3, 5, 7, 10 years, it's significantly attractive. The last point I mentioned in terms of energy transition, if you were to look at just the large and growing energy transition, yes, it's oil, yes, it's gas, yes, it's nuclear and hydro and renewables, because the modern global energy system requires significant source of fuels, both hydrocarbon and non-hydrocarbon. So the amount of investment in just achieving net zero by 2050 is 125 trillion. We don't have it. It's a huge investment gap. But what you're seeing is a significant portion of the energy transition is being financed through credit. And we've done, over the last, call it year and a half, a significant amount of research and capital work in private infrastructure, structured credit and debt that I'm happy to talk about, and any of the projects, answer any questions about just specific projects, risks, and opportunities within that space. Because I think it's private credit, particularly structured in some of the spaces in renewables, there's a unique opportunity set that roughly $60 trillion worth of infrastructure and the energy transition to zero emissions will be financed through private credit and the private debt markets. Enhancement of aging infrastructure, we talked about it. The American Society of Civil Engineers report, I mentioned this, overall grade C-. Not a failing student, but not passing adequately. And if you look at the aviation system in the United States, it is 50 years old. We had a shutdown earlier this year in January, where this complete FAA system was shut down for 4 hours. You're seeing things in the United States like bridges, whether you're talking Philadelphia or Pittsburgh, bridges are literally failing before our eyes. So you're seeing a failure in fiscal infrastructure, and the amount of capital that's required for investment here is a little over $2.6 trillion. And that's the spending gap over 10 years from 2020 to 2029. So that's just within that sort of decade period, decade less. So it's airports, seaports, toll roads, stormwater, transit, and wastewater across a series of geographies from north to south, east to west. And so that enhancement of aging infrastructure is a significant mega trend that admittedly is providing opportunities where we've put money to work in water and sewer, as well as remediation and utility upgrades that have provided significant return on capital in terms of our investment, but also provided a significant impact in terms of enhancement of aging infrastructure. And when we look at it beyond just the U.S. report from the American Society of Civil Engineers, if you look at it on a global level, the global infrastructure gap is enormous. The amount of investment required, 94 trillion, with roughly 79 trillion as the current investment trend. That's the ramp where we're targeting, but there's still a $15 trillion gap. And that investment gap, basically the amount that's required by 2040 just to maintain and modernize current infrastructure. And again, that's across sectors: water, transport, ports, airports, telco, and even energy. There's a significant and growing opportunity set that will need an investment from both public pension funds, sovereign wealth funds, call it the institutional sector, as well as we're starting to see democratization of the asset class infrastructure through some of these retail or mass affluent vehicles that are aggregating capital and investing in space. So one of the other things we talked a little bit about with the enhancement of aging infrastructure is making an impact. And not all investments in infrastructure are going to make an impact, but what we'll find is a significant amount of the investment in infrastructure aligns very well with the United Nations Sustainable Development Goals, the SDGs. You've heard of them. I think a lot of people are trying to make an investment and trying to measure their impact. I can talk about that in the Q&A. But when you look at what's going on, it's across water and clean water and sanitation, affordable and clean energy, industry, innovation and infrastructure. And we're starting to see smart communities, smart cities with the investment in digital infrastructure and energy transition is really starting to play where it's making a difference in lives, but it's also making an impact, creating jobs, as well as increasing the economic vibrancy while decreasing carbon footprint and decreasing some of the negative externality with commercial development. So I'll take a step back here. When you look at all of the typology of investments, whether you're talking publics or privates, fund investments, direct investments, anything like that, some of the things that you'll see in terms of vehicles in the marketplace are, for lack of a better phrase, a series of investments that can be accessed through public markets, private markets, listed vehicles, mutual funds and ETFs, as well as in private markets. Historically, you've seen private infrastructure partnerships. So with liquidity, mutual funds, listed infrastructure securities, that's easy. Daily liquidity at a market price, but you're going to get market beta. With private infrastructure partnerships, you get minimum to call it no liquidity, 10-year term vehicles closed end. You're starting to see 40 Act interval funds listed and private combined, in which you get quarterly liquidity with an NAV. And so you have a modified or hybrid capital structure that interval funds are starting to solve for things like that. And when you look at just the investment historically where it's taken place, a source coming out of fixed income, a source coming out of equities, where you take 3 to 5% out of equities, 3 to 5% out of fixed income. Investors have been using that to fund their infrastructure allocation. One of the main reasons, the low to, I would say, less meaningful correlation to public equities. With listed infrastructure, you're going to see a medium to high correlation. With private partnerships, you're going to see low to no correlation. And again, with interval funds, it's low to no correlation. So that inherently lends itself to the private partnerships and interval funds providing a significant investment tool within your asset allocation model. We talk about volatility. Clearly, listed infrastructure, mutual funds, ETFs, you're going to have a more volatile environment. Private partnerships with a quarterly NAV, less volatility. 40 Act interval funds, you're going to have a little less volatility, still daily marks, but under underlying privates, you're going to provide for less volatility. When you look at just disclosures, public markets, you're going to have SEC filings, private markets, minimal required disclosure according to PPMs. With a 40 Act interval fund, you get the best of both worlds, in which you get public SEC filings, but underlying private market investments as well. The accessibility, you've got minimums in private markets that are typically around 5 to almost 25 million. With public markets, again, it's accessible to all investors. With 40 Act, accessible to all investors. So you get a little bit of a different bent there. Diversification, I as a portfolio manager, I always try and diversify by interest rate, diversify by economic sensitivity, but also provide some portfolio diversification. So whether you're talking listed or even private markets, there's a way to layer in investments by subsector, by interest rate sensitivity, economic sensitivity, so you can get better risk-adjusted returns with a fully diversified portfolio. You can achieve that through publics, you can achieve it through interval funds, through privates. It's a little bit more tricky depending upon how much capital you have to invest, i.e. if you have 15 or 20 or 25 million, you can get adequate diversification, but typically the high barriers to entry with private markets are a little bit more challenging. And last but not least, tax benefits. If you were to look at public securities, you've got the depreciation benefit. With private market securities, you've got K1 tax reporting and depreciation there, as well as with 40 Act interval funds, you've got depreciation, but you also have single 1099 tax forms. So you've got a bit of a hybrid opportunity set with interval funds. They've created a structure over the last 20, 30 years that now infrastructure has been access through interval funds. So there's a different way to access a private market asset class. It's typically been reserved for institutional investors. So I can talk a little bit more about key takeaways. I'm going to be cognizant of time. We're about 30 minutes into it. I think when you look at key takeaways, infrastructure as an asset class, it's truly global. And as an opportunity set, it has the support. It's underpinned by structural global megatrends. Those megatrends, again, energy transition, digital transformation, enhancement of aging infrastructure. The historical returns, they've been in that sort of 12 to 12.5%, and predictable income, 5.5 to 6% of that is income. And when you look at the volatility, low degree of volatility in that, just a touch over 3% volatility over full market cycles, combined with low economic sensitivity and inflation protection, it adds a different element of investment that's dissimilar from real estate, dissimilar from equities and fixed income, but yet it provides portfolio diversification benefits. So I think when you look at all of this and then overlay, the investment opportunity set and the ability to align with several UN Sustainable Development Goals, I think you've got an investment that aligns well with generating a financial unit of return, a social unit of return. It's not squarely focused on ESG, but the asset class lends itself well, things like clean energy and clean water, as well as reduced carbon emissions. It lends itself well to investment by investors that are seeking to generate a unit of return, but also making a moderate impact with some of the capital that they're putting to work. So I've talked about takeaways. I can go back to some of the investment goals and aging infrastructure, but I'd like to open it up for questions a little early because I see there's a couple questions here in the chat, and see if we can open it up. Let me do this and open it up for any questions, comments, concerns. I see here, how much of the future U.S. infrastructure spending or bill is dedicated to promote green materials, for instance, green cement, concrete, in an effort to encourage decarbonization? So, Bessie, thanks for the question. When we look at infrastructure spending or the Infrastructure Investment and Jobs Act, as well as the Inflation Reduction Act, you're seeing small single digits, 1-2% allocations dedicated to promote green materials. So whether you're talking green cement, concrete for large scale construction, you're starting to see an acknowledgement that carbon emissions, one of the larger sources of carbon emissions, is concrete manufacturing. And so there's a small but growing allocation to green cement, green concrete. Roughly about $5 billion is being put to work out of the Inflation Reduction Act, which doesn't sound insignificant, but it's a smaller amount of a larger package, into the materials supply chain to try and stimulate investment growth. What you're also seeing is, recently the current administration put forth a north of $40 billion, almost $45 billion package to promote spending and provide tax credits, for lack of a better phrase, for commercial construction and transition from office to residential or multifamily. And when you look at that type of bill, again, more fiscal stimulus, it's aimed at construction, both new but remodeling, and any new as well as remodeling requires concrete, and that green cement, green concrete will be a significant part of the overall build out, as well as the overall retrofitting and refurbishing of commercial construction and some multifamily construction nationwide. So another question I had that was posed to me, and this was one of the pre-panel discussions, just seeing how you would incorporate infrastructure into an asset allocation model. One of the things that we've seen, and I think it's a combination of both what you're seeing in institutional investors as well as retail investors. Forgive me, let me put this back here. We're seeing more acknowledgement in a higher for longer rate environment and a sticky inflation environment, that you're starting to see more and more investors seeking out income that's not correlated to fixed income. And the ability to find sources of income, real income, tied to underlying asset income as well as inflation protection in real estate in an accommodative monetary policy environment worked significantly well for about 10 to 12 years. Now you're starting to see the big, margin call in commercial real estate. One of the things I'll be talking about later today is with a commercial property executive, some of the things that are going on with repricing, CMBS, different types of real estate and property loans in the commercial office sector is really becoming a significant concern, a ticking time bomb. So I think a lot of investors from institutional all the way down through mass affluent are seeking income to replace or complement their real estate income. So we're starting to see more allocations coming out of real estate, particularly commercial office, and coming in to fund infrastructure allocations in both public and private markets because they can get meaningful exposure, meaningful income, as well as meaningful inflation protection. Income ranging from 5 to 6%, call it 5.5%. So something like that is a complement to their cash as well as complement to their other types of fixed income, but it's real asset income with underlying inflation protection. So I'm going to stop here and ask Todd, did you have any questions?
Hi, Michael. I don't see any other questions right now. For all our participants, does anyone have any further questions right now?
So Todd, let me put this back to you and ask, because I don't see any either. So when you look at some of the things that we've, over the course of going back and forth structuring this panel, when you look at some of the things, what do you think are the biggest challenges facing investors today?
Oh goodness, I don't think I'm qualified to to speak to that. I don't know. I see that Ed is on the line right now. Ed, if I could put you on the spot for a second, maybe you would have some ideas of what those biggest challenges are for Michael. Ed is on our education council.
Got it.
Hi, sorry, just unmuting. I'm a fixed income guy, so I would think financing would be a big issue going forward.
Correct.
But it seems, just to generalize, I would think that one of the biggest issues would be that the transition from the desire that a lot of people have for short-term returns versus doing this more as a long-term opportunity.
And I think that's to your point, and it's long-dated 30-year contracts, fixed rate debt, where I'll give you an example. Some of these investments in private markets are yielding 9 and 11 and 13%, of which you're getting a fixed rate of 9 or 11 or 13% on a 30-year contract, with the underlying asset exposure that are things like digital infrastructure, in which you're seeing a large and growing opportunity set. And so that's, I had suggested, referred to it earlier in the conversation, when you look at infrastructure debt, it's a significant and growing opportunity set, north of $300 billion of capital that's racing to the space, trying to solve the energy transition as well as digital transformation. And so to your point, as I started out as a fixed income analyst at Lehman Brothers in '92, so I'm a bond guy that went to public markets and private markets, and I look at things with a skeptical eye. The glass is always half empty, right? And so I look at this and say, what's some of the best way to play infrastructure through private credit or private infrastructure debt, making loans in the areas where projects are 10 and 50 and $100 million projects, with data centers and cell phone towers and smart grid infrastructure and fiber to the home, because that underserved small market is a significantly large but growing opportunity set where banks have just shut down lending. You saw it with Silicon Valley Bank and First Republic, some of these other bank failures. And so banks have literally just shut down lending in the small and mid market, and they're not loaning money to local digital infrastructure companies and private markets. They're not loaning money to the local sewer authority or water authority, despite the fact that whether you're in a financial recession or depression, people continue to flush their toilets and take showers. These are things that are essential services within the community at the county, municipal, state level, in which financings are becoming more and more difficult, but private capital is stepping in. So I see we have here in the chat. Got it. Slide deck, we'll get you a copy of that. How do you invest in aging infrastructure? Are you buying the companies that are building the roads and bridges? No. So thanks, Alan, for the question. When you look at what we're doing, it's not investing in construction and engineering companies. It's investing in the regulated assets. So think utilities, think about big projects, and whether you're investing in private market holdcos or operating companies, these are across a continuum of again, these sort of big themes in energy transition, digital transformation, enhancement of aging infrastructure. So we're buying the physical assets, but we're buying them within a holding company. Said another way, think about pipeline operating companies, master limited partnerships. They're publicly traded. In private markets, there are hundreds of private companies that operate pipelines in which they are involved in transportation and storage of oil and natural gas, and buying these companies and helping to provide critical financing equity in debt companies is significant in an environment in which they're starved for capital. So investing in private companies in energy transition, as well as digital transformation, enhancement of aging infrastructure, these private companies provide significant opportunity for capital appreciation as well as yield. Next question. How are high interest rates and the resulting higher yields on private credit affecting investor appetite in infrastructure equity? Great question. So what we're seeing is infrastructure equity funds and projects that are seeking equity are having a harder time of raising capital. So fundraising has been extended 3 and 6 and sometimes 12 months for infrastructure equity funds, for example. Their fundraising has been more challenging. Investors are less inclined to commit to equity, more inclined to commit to debt. Or, for example, I spoke to a GP just this morning, and they had shared with me that their infrastructure debt fund, I'll just pull the numbers right here, their levered infrastructure debt fund has an 11 to 14% return profile, yield to maturity is 13%. Their unlevered fund has about an 8 to 10% profile, again, unlevered infrastructure debt. So when you look at those types of profiles for returns, infrastructure debt's more interesting than equity. You can access it through both levered as well as unlevered type of pooled vehicles, infrastructure funds, debt funds. But I think what you're finding is in the equity space, GPs have been extending their fundraising. They've had challenging times. We've actually seen, whether you're looking at Preqin data or other types of industry aggregated data, pension funds have been pulling back from infrastructure equity, and they're allocating to 2 different buckets: infrastructure debt, diversified funds for infrastructure debt, and then infrastructure secondaries, of which there's a few reports that came out there. We just wrote a paper on this about infrastructure secondaries. You're starting to see pricing that's anywhere from 95 to 90% of net asset value. Said another way, existing infrastructure equity funds, you can buy them for a 5 to 10% discount, sometimes more, depending upon sourcing and sizing. If you're putting 5 million or 50 million to work, you can get a better price point on your NAV discount for infrastructure secondary. So higher rates, higher yields on private credit, investor appetite shifting from infrastructure equity to infrastructure debt and infrastructure secondaries. Thanks for the question. So what would be the tax policy implication or dynamics in the US given the persistent higher rate for longer and persistent inflation environment? Will the tax hikes be a possibility factor that may make investment return may impact the investment return in the infrastructure space? I think the short answer is yes. The longer answer is, political will for tax hikes in the US is little to none. And when you look at what's going on, That's been one of the few things that both Democrats and Republicans can agree upon, and that's infrastructure investing. It's a form of fiscal stimulus. It doesn't inherently cause a line item tax to the consumer, but what it does, it investment in infrastructure actually does create job growth. For every $1 billion invested in infrastructure, 42,000 jobs are created. Those jobs are not minimum wage jobs. You're talking building trades, so electrical workers, steam fitters, all the jobs that are in what's called the building trades, union labor building trades, of which these jobs are paying $45 and $75 and $100 an hour in the building trades, where they're making, so there's wage inflation created, economic growth and productivity vis-a-vis infrastructure investment, fiscal stimulus. So the left and the right have agreed on nothing except for infrastructure investing as a solution, because it does create jobs. And when politicians create jobs, they're able to curry favor with their voter bases and potentially get themselves reelected, which admittedly politicians, that's one of their main jobs, is to get themselves reelected. I don't cast judgment. That's just the way they see the roles. So infrastructure investment's been a bipartisan focus for well over 5 years, closer to 10. And when you look at that, the probability of a tax hike instead of passing another fiscal stimulus is low. And all we have to do, if you were to take a look at take a page out of history in Australia, 30 years ago under Prime Minister Kennett in Australia, they had massive fiscal deficit issues. They had no political will to increase taxes. And what do? They resorted to infrastructure investment as fiscal stimulus to nudge the economy forward, create jobs, create wage inflation, create more of an economy that was a little bit more stable, which they did. And then if you were to move to the UK under Margaret Thatcher, similar situation. They had Severn Trent, Thames Water, large water utilities, transit, electrical utilities that needed critical financing, but they didn't have the political will to raise taxes. So what do? Created infrastructure stimulus bills, and that drove capital into the space. And then you saw companies that were infused with both equity and debt, and you saw spin-offs in which companies were taken public. National Grid's a great example in the UK, where you have a publicly traded utility available on a stock exchange so they can get access to critical financing. So, implication, tax policy, I think there's a higher probability for more fiscal stimulus, which will create more inflation, admittedly, as well as more economic growth. And I think when you look at it, you're starting to see effects of the Infrastructure Investment and Jobs Act, as well as the Inflation Reduction Act, that's been moving the economy forward and providing, albeit some bright spots in an economy that's otherwise a decelerating economy. And we've got about 12 minutes left here. Any other questions? So Alan, I'll ask you to chime in here if you're available, because I know you always have one or two unique questions or insights that are helpful.
There, sorry, I wasn't able to unmute, but I'm able to now.
That's okay, Alan. We can hear you loud and clear. Go ahead.
Well, I guess I missed what am I adding some insights on how to access this?
Well, I think more than anything else, Alan, I think we've had these conversations in the past, and some of the biggest challenges investors have with infrastructure as an asset class is access to a diversified portfolio, the proper allocation size and proper allocation amount. Any other things that you think would be helpful just in terms of outlook or even asset class commentary?
That's why I have you come travel with me wherever I go, because you're the expert in it. But I do, as I'm out in the field, see a lot of people that really, for lack of better words, are kind of ignorant in the space. They mostly think, oh, I've got my infrastructure covered through some utilities or through a public listed ETF. But I read a stat the other day that I think only a small percentage, like 10% of infrastructure, you could probably talk to this, but only like 5 or 10% of infrastructure assets are actually publicly listed. and the rest are privately listed. And when you look at that and what people are actually allocating to, they are extremely, as a whole, under allocated to infrastructure, where we are, in some mega trends. And most people, it comes down to, how do we get it? The only place we could find it was either $25 million minimums or through, a publicly listed ETF or mutual fund. So I think just the advent of interval funds and the ability to democratize private infrastructure is one of the maybe coolest, not just, for us, but in the industry. The interval fund is maybe one of the best tools for bringing something that was very difficult to access down to the mass affluent. It could be one of the biggest kind of innovations, I think, in the industry over the last few years.
Yeah, thank you, Al. I think, in the discussions we've had, it's also been about concentration, where they've allocated to a wireless or digital infrastructure for private placement, or they've allocated to a renewable fund in private markets. Said another way, it's almost like giving Tiger Woods a 5-iron and expecting him to play his best round, right? To have access to one element or aspect of infrastructure like renewables, or one element or aspect like digital, it is like playing a game of golf with one or maybe two clubs, as opposed to a full array of clubs, where you have multi-sector exposure, as well as resiliency from an economic perspective and an interest rate perspective. I think we touched upon this, but when you look at interest rate sensitivity and economic sensitivity, this is one of the favorite slides. I think investors, we've had conversations, Western State CFA Society, we did this presentation earlier this year, and the CIO from Bank of Hawaii was asking about exposure to nuclear, as particularly through public markets, nuclear utilities, whether you're talking Constellation Energy or small scale nuclear through companies like NuScale, in which they're coming up with a new technology in which they have a nuclear reactor that's the size of the nuclear reactor that's in a Navy sub. They're putting it into a stack that's 12 feet in diameter, 80 feet high, and they're co-locating it, dropping it right inside the ring fence of a coal-fired power plant, shutting down a coal-fired power plant, lighting up a nuke, and these small-scale nuclear devices are actually able to power 250,000 homes. And you're seeing it in the Northeast, you're seeing it in the Great Lakes region, and you're seeing it in other parts of the heartland and the central swath of the United States. So nuclear is starting to become a viable opportunity set, just from a development standpoint, but also nuclear utilities and nuclear companies. NuScale is sort of smaller, cute. Constellation Energy, large, dominant, defensible market share, largest nuclear fleet within the United States. The other thing that you touched upon in terms of under allocation, the S&P 500, whether you're using a 60-40 model, or if you're using an outcome-based investment model, large cap equity ETFs, large cap equity indices typically have less than 5% allocated to energy and less than 2% allocated to infrastructure. So I think we have one more in the chat.
One last thing I'll mention on there, Mike, too, is when you look at this slide, I always have people, their eyes kind of pop when we talk about, when you want to cover the universe of infrastructure, you have to really understand the economic and interest rate sensitivities. And just buying an ETF that's a static index is not going to play to that. And, as we start seeing more actively managed go anywhere funds, I think that's a really crucial. When interest rates were zero and everything was going up and rising with the tide, it was great. But now that we're in a different environment, having an actively managed infrastructure portfolio is crucial.
Yeah, well said, Alan. And I think we have a little bit of time here for this last question. So thank you for that. You've highlighted the underinvestment in water infrastructure, but it seems few infrastructure funds are allocating capital to the sector. Why so? And what do you think needs to change to move investment to come into the water sector? I think, excellent question there. When you look at the water sector, you've got, public markets, you've got 52 companies that are water technology, another 55 companies that are publicly traded water utilities. 2 just merged in the last year. Xylem, one of the largest water companies in the country. In private markets, what we've seen is a lack of investment. There's two different GPs that are out raising money for a water investment strategy. One is trying to buy farmland in which they fallow. They actually stop producing farmland, alfalfa, for example, out west. And then they access the underground aquifer, in which then they're taking that water, using it, and trying to transport it to consumers as well as commercial customers. That's one way you can play water. That's taking more of commodity risk, and it's a different opportunistic or private equity way to invest in water. The other way I've seen investment in water is through utilities, in which you can buy into various utilities. Right now, you have north of 500 privately owned water utilities in the United States. Underinvestment in the space, I think, has been a result of the aspect of water in the US, where it's essentially been free until it's been bundled into various utility packages. And now you're starting to see water utilities that are actually charging and increasing the re-rating for water utilities. That gathering momentum, particularly in light of scarcity of water over multiple 20, 30, 40-year market cycles, is spurring investment in water utilities, water efficiency, water metering, and different types of technologies that are reducing water usage, increasing flow, as well as build out of water utilities. And whether we're talking the environmental threats of water utilities in Flint, Michigan, where the pipes are made of lead, and there's actual lead poisoning, where there's a desperate need to go in and conduct environmental remediation, replace the pipes, replace the water systems, but also replace them with efficient systems that also have metering and technology to them, with companies like Badger Meter and others. But I think, to your point, private water investment has been slow, but it's been accelerating over the last 3 to 4 years. So I see we're about 11, I'll call it 12:57 here. Any other questions before we close? Okay. Well, I will give you back a few more minutes in your day, ladies and gentlemen. I appreciate your time and attention today. And again, we'll provide a copy of this presentation to all of the attendees, and happy to schedule a time to speak offline with any of you about any items you may want to pursue: public markets, private markets, infrastructure investing, as well as portfolio management. So, ladies and gentlemen, thank you very much for your time and attention. Have a wonderful day.
Excellent. Thank you so much, Michael. Everyone, thank you so much for attending.
Thanks.